Good morning, everyone. Welcome to another Smart Knowledge U podcast. Today is April 1st, 2016, and today's podcast topic is confirmation bias, a topic I also address in our soon-to-be-released Smart Wealth Academy curriculum. And just for a quick update on our Smart Wealth Academy, it's been taking a lot longer to complete than we had desired. Basically because of the animated videos are taking so long to complete. They're really labor intensive. Sometimes it takes a full 8 hours just to complete one part of one lesson, and there are multiple lessons in all our courses. So as you can imagine, that adds up to thousands and thousands of hours of man hours. So we actually may be launching a GoFundMe project or something similar to that, which we'll address on our website at smartknowledgeu.com, just so we can hire more people to try to finish this up on a more timely basis. So keep an eye out on that. So let's get started with today's podcast. We actually have a couple of vlogs that we recorded but have not yet released. So we will probably, however, release this podcast first. So we're just telling you that. So we'll have some more podcasts and vlogs being released soon on our YouTube channel. So keep an eye out. But as the subject material of this podcast and the points of discussion of this podcast may be more timely and relevant to gold and silver investors, we'll probably release this one first. So confirmation bias has been the bane of investors since the beginning of time, as it frames all information only in the light that we wish to view information. In other words, we tend to cling only to information that supports what we want to happen while discarding all other rational, intelligent information that may be out there that conflicts with what we desire to happen. So our last vlog was an example of this. I don't know if it's a perfect example, but it certainly is an example of this, because of the 13 vlogs I've released so far on our Smart Knowledge U channel on YouTube. I believe, I'm not certain because I didn't go back and check all 13 vlogs, but I believe this vlog had the most amount of dislikes of all the vlogs we have released since the beginning of our vlogging experience, though this vlog contained many, what I felt were pretty emotionally neutral observations. So why did it receive so many dislikes? I believe that it received so many dislikes not just because it went against the grain of popular sentiment in the gold and silver blogosphere at the time, but and obviously if something goes against what the masses believe, it's going to receive a number of dislikes. But also, I believe it received the most amount of dislikes of any Smart Knowledge U vlog, because within that particular vlog, I went against the wishes of those that are long gold and silver, even though in my subscription services, we're long physical gold and long physical silver too. So many don't even know what the positions are of those that may issue statements that are contrary to the popular opinions of the time, and they don't even look at that. Well, in that case, they can't know unless they're paying subscribers, because they don't know our positions if we're long or if we're short. But in fact, I titled my SKU, Smart Knowledge U vlog 013, released on March 4th, Get Ready for Another Banker Raid in Gold and Silver. So this is another interesting facet that I'll discuss within this podcast. Is just because I said get ready for another banker raid in gold and silver, I didn't say it was going to be an extreme raid. I didn't say how much of a raid, because I didn't give any price points as far as where I felt that raid would take gold and silver down to. But I'll discuss the interesting kind of interpretations of this vlog that occurred without people even knowing exactly to what extent I felt this raid would materialize. So just because 5 trading days after this podcast, gold actually climbed higher to a high of $1,287.80 an ounce, and silver reached a high of $16.17 an ounce, and the Huey Gold Bugs Index shortly after that reached a high of 189.13. Many dismissed my vlog warning as inconsequential, but in the vlog I stated that if one wanted to execute basically a rational strategy, that one should consider locking in profits on paper gold and paper silver mining stocks if one were keen on using a low risk, high reward investment strategy due to the large risk I identified in another imminent gold and silver price raid. So I stated two other really important points that all intelligent investors abide by as well. Number one, I stated that ignoring clear risk and executing high risk and high reward investment strategies can often lead to higher gains. That is true. But that eventually executing high risk, high reward strategies will lead to tremendous losses at times as well. And this is definitely true as well. And for example, granted, we exited in what amounted to be a time too early from the mining stocks this year due to the increasing levels of risk that I identified in paper gold and paper silver markets. But the key is that we still exited with very healthy profits in a period of just a couple of months, though we did leave gains on the table. But last year, too, this is the contrary point, okay? So we can't always assess everything in a very condensed time period and say, oh, well, you know, this low risk, high strategy does not work because you're leaving gains on the table in 2016 by executing low risk, high reward strategies. So you definitely want to be high risk, high reward strategies in which you would have been all in this year and try to squeeze every single gain before this turns around this year. But you have to look at, well, what would these high risk, high reward strategies have produced last year? Because last year, we returned over a 35% yield in our gold and silver mining stocks and our platinum membership. And a year, the mining stocks lost about negative 38%. So when you execute low risk, high reward strategies, that means in down years, you're going to be losing more money than just the indexes as well. Because in the up years, you're making more money than the index returns, but in down years, you're losing more money. So how we executed high risk, high reward strategies in 2015, it's very safe to assume that our losses at a minimum would have been negative 40% because the indexes alone lost negative 38%. So just to get back to even this year, we would need an 80% gain this year overall in all our mining stocks. So this year, if we look at thus far, the Huey Gold Bugs Index, granted, has been on a tear as well as the Philadelphia Gold and Silver Mining Index. But still, even up to this point this year, we would still need an additional 30% rise in the index just to get back to even how we executed high risk, high reward strategies both last year and this year. So that tells you the inherent risk of always executing high risk, high reward strategies, trying to squeeze every single profit out of the gold and silver mining stock. So high risk, high reward means basically being all in all the time, or translated another way, buy and hold for paper assets. So most people don't tend to think of buy and hold as a high risk, high reward strategy, but it is when it comes to paper assets. And it's highly unlikely that one did not sell out precious metal mining stocks last year, at any point last year. In other words, executing a high risk, high reward strategy and having lost negative 40% last year, that one would do so at any point this year. So let's look at what has happened with gold and silver since my warning on March 4th up until April 1st. Gold has fallen by more than $54 an ounce, or negative 4.2% an ounce. Silver has fallen by more than 62 cents an ounce, or negative 3.8% an ounce. And the Huey Gold Mining Index has fallen over negative 6.1%. So obviously there was some merit to my warning about a pullback in prices being a valid, rational warning that issued on March 4th, even though it was hated by a lot of people. And it was not a ridiculous warning to give since there has been a pullback in prices since I issued that warning. Granted, given the spectacular rise in gold and silver paper assets during the first quarter of 2016, I am acknowledging this is not a huge pullback in prices, and that expectations among the majority of the gold and silver community, from what I've seen on on the online and on the internet, is that the pullback is now over and that gold and silver paper assets will resume climbing much higher in the immediate and short term. However, it is always premature to assume these things without supporting evidence. And here is where this discussion of confirmation bias comes into play. Confirmation bias makes us see only what we want to see. It makes us hear only what we want to hear. And it makes us ignore everything else. So it makes us dwell in what I would call the fringes of rationality, which I believe everyone would admit is dangerous to one's investment strategy, to dwell in these fringes of rationality. For example, if we are long paper gold and paper silver assets, and many times we are, even in Smart Knowledge U, because we are very bullish gold and bullish silver advocates. If you look at the most extreme, we tend to, in the framework of confirmation bias, look at the most extreme examples to confirm our desire for gold and silver to go higher when we are long gold and long silver. And likewise, on the contrary, if we are short paper gold and short paper silver assets, we look at the most extreme examples to confirm our desire for gold and silver to head lower. And both these confirmation biases, both when we are long gold and silver assets and when we are short gold and silver assets, is a dangerous thing to do, and it's easy to avoid if we can recognize it. So typically we ignore everything that exists in between the two extreme outlier positions, the moderate voices that dwell within the realm of rationalities. So for example, if we're long paper gold and paper silver assets and we receive a 6% pullback in one day in mining stock prices, and prices the next day start moving higher, we listen to all the voices that say, hey, the one day pullback in prices was it. The pullback's over now, and if you didn't get in on that one day pullback, your chance to get in is now over, and PM mining stocks are set to continue climbing much higher again. This is what we listen to. So now listen very close to what I'm saying. I'm not saying that there's no possibility of this prediction coming true. There's always a chance of this prediction coming true. But I'm stating that 999 times out of 1,000, we never bother to look at the rationale behind such predictions. And I mean really look at the rationale behind such predictions, because the prediction supports what we want to happen. So we just look at the prediction and say, hey, this is what people are saying, this is what I believe, so let's continue holding that position. And I've read the explanations behind such predictions, and they're always the same. The global banking system is in disarray. The US dollar is likely to continue to weaken this year. Gold will continue to head higher this year, and so on. In other words, the fundamentals support the position that gold and silver mining stocks will not pull back and they'll continue to go higher this year. And while I agree with the assessment of the fundamentals are strong, the fundamentals were super strong in 2008 when bankers crashed gold from 1,000 down to 580. The fundamentals were super strong in 2013, I believe it was. Let me go check really quickly. Was it in 2013 when they pulled back gold from $1,700 very quickly as well? Just bear with me for 1 second while I look at the multi-year chart for gold to make sure I have the year correct. Yes, it was 2013. So the fundamentals were just as strong as they are today, and they were able to really take down gold and silver. And again, people are saying, hey, look at what's going on in the physical gold market. There is it's very tight, the physical gold market, which is true, but the physical gold markets were very tight in 2008 and they were tight in 2013. And so people are saying, because they're so tight now, if you really look at the fundamentals of what's going on in the physical gold market, they said the banker manipulation schemes and the price takedowns of gold and silver are over. But I will also go into this podcast why I believe this also not to be true. It's not over as of yet. It's weakening, but it is certainly not over. So if the PM stocks are poised to continue to explode higher with no real correction, as is the pretty much it's the accepted sentiment amongst most gold and silver bulls at this time, except for yours truly, and this case is backed by fundamental support, then what, if you're really looking at the fundamentals, looking at the nitty gritty, right? And I agree the fundamentals do support a gold and silver bull continuing, and I am bullish for this year. But what about the PM mining stocks that spiked higher in share price during the first quarter of 2016 that just ended after they reported huge losses in earnings and huge write-downs in inventory, because there were a handful of PM mining stocks that defied the fundamentals. Their last earnings statement looked terrible, but they all spiked continually higher. So fundamentals, if you're looking for a fundamental position, you're saying, look, the fundamentals behind gold moving higher are very strong, which again, I agree with. fundamentals, and you can't say, hey, I'm looking at fundamentals for why I believe mining stocks will continue to go higher because fundamentals in gold are so strong, but then completely ignore the fundamentals of the individual mining stocks, because fundamentals of those PM mining stocks, and there were a handful, again, that spiked higher, way higher share price this year after reporting terrible earnings statements. It would have dictated that their share prices headed sharply lower and not sharply higher. And this is what I mean by confirmation bias. We just like push that to the side because, you know, basically the strong rise in PM mining stocks this past quarter, we did have that cliche of a rising tide will make all, what is it? That stupid saying, a rising tide will pull all boats higher, or whatever that saying is. So we know that there have been times since this financial crisis started in 2008, because in reality, what we are experiencing today is not a new crisis, but merely a continuation of problems never fixed in 2008. That banking stocks spiked much higher during short periods of time between 2008 and today, despite the earnings reports that revealed huge losses on their books, huge markdowns and write-downs, and even sketchier accounting tricks where they refuse to mark their assets to market and use some fantasy internal valuation model to cook the books more than even Enron accountants cooked the books of Enron when, you know, Enron went to hell and it was all revealed as to be a huge scam. And when that happened, if we were honest with ourselves, most of us screamed fraud. You know, that it was pure fraud that caused the share prices of these banking stocks to spike. But most among us didn't pause for a second to think that just maybe, as bankers suppress the prices of paper and gold and paper silver assets have done so since 2011 in a furious manner, that they may also be participating in manipulating paper gold and paper asset prices higher during the first quarter of 2016 to reap profits, when this is really the only profitable sector out there during the first quarter of 2016, like significantly profitable sector. So there's certainly clear signs that they have done so, and I've discussed these clear signs with my subscription only members. But confirmation bias will trick us into believing that bankers only manipulate prices downward if we are long precious metals. So we always say, oh, bankers are responsible for manipulating prices downward, and that is true. But we never, or most among us, due to confirmation bias, will never acknowledge that they manipulate paper, gold, and paper asset prices higher when we are long precious metals as well, because we don't want to consider that they may be an important factor in the rise of precious metals and paper gold and paper silver assets, because we want to feel that this is a sustainable trend. And long term, again, it's sustainable. I'm just talking about what will happen in the short term. So to answer the question of whether or not bankers manipulate precious metal prices higher from time to lock in quick profits, answer this question. Consider this question, because it will reveal how unreasonable and naive it is to believe that they do not. So in Forex markets, oil markets, interest rate markets, and stock markets, have bankers rigged these markets up and down? Both up and down, not just downward, but both up and down to reap profits. If you really understand what's going on in financial markets, and if you've been following the news, you know the answer is definitively yes. They have moved markets in both directions, up and down, to produce undeserved huge profits for themselves. And in fact, in 2013, a Royal Bank of Scotland banker compared the frequency of his manipulation of a key London interest rate, both up and down, to the frequent movement up and down of, in his own words, a quote unquote, whore's drawers. So when bankers' manipulation of every capital market in the world, both up and down, has been proven and acknowledged by bankers' own emails, I believe it is incredibly naive of people to think that bankers do not interfere in precious metal markets to drive the price higher in extremely rapid fashions to produce rapid fire gains for themselves as well, especially at times when this asset class is the only class returning significant gains, as was the case during this previous quarter one in 2016. Furthermore, And secondly, just because someone states an observation prediction does not mean that this person wants this observation to happen, nor does it mean the prediction has to result in an extreme outcome. So this, to me, is one of the most troubling interpretations of warnings of real probabilities of events, whether it's warning of a U.S. stock market crash or warning of potential significant pullbacks in gold and silver prices in the investment world that I persistently observe. One should ever warn of a coming banker gold and silver raid when PM prices were moving higher, or warn, as I did, of a coming U.S. stock market crash just 17 trading days before it happened, or reveals that they have been short during a banker gold and silver raid. In my U.S. stock market crash call came in 2009. People will jump all over you and express disdain for your view, falsely trying to accuse you of wanting that predicted outcome to happen. It doesn't mean just because you observe certain risks that you want that outcome to happen. In fact, it's just many times people putting out their truthful observation. So again, this plays into confirmation bias, because if you're long those assets, at times people predict that a pullback could happen, or in the case of U.S. stock markets, a crash could happen because it goes against possibly one's own desire. You will then accuse that person of being on the side of bankers, saying you want a wealth destructive event to happen, which is the furthest thing from the truth. And again, it's confirmation bias speaking. So over the past several years, in fact, at Smart Knowledge U, I've predicted several gold and silver banking raids that actually happened after my predictions. And at that time, unless you are a paying subscriber, you did not know that we were still long physical gold and long physical silver. So it'd be ridiculous for us to say that we wanted that to happen, because obviously if we're long physical gold and physical silver, we want the prices to rise. We don't want a pullback to happen. But if one doesn't understand why one would be long physical PMs at the same time one predicts a banker rate in paper gold and paper silver, then I would say one obviously doesn't understand the huge differences between paper gold and physical gold, and between paper silver and physical silver. So if you don't understand why we belong physical gold, physical silver, at the same time we're predicting a banker rate, paper gold, paper silver, then this is probably a person that would probably be fine owning the paper gold and paper silver ETF and having no ownership of any physical gold and any physical silver. So obviously, if we believe a banker rate is on the way and we're long physical gold and long physical silver, we often have to take hedges in the paper world to produce gains that will offset the decreases in the prices of our physical stacks. But it's not to say we want that event to happen. So if we fully understand that people that have a vested interest to see higher prices never want to hear about the possibilities of lower prices ahead. But that's a burying your head in the sand kind of moment, and that's just silly. So there's a huge difference between discarding opposition viewpoints and discarding solid viewpoints that are vested in reality. And finally, as I stated above, confirmation bias will lead people to frame opinions in extremes and to ignore the moderate view that exists in between. So, if we are long gold and we are long silver, we tend to focus on people that state huge, ridiculous crashes are coming. Like Harry Dent, who continues to push propaganda of a gold crash to $700 an ounce with seemingly every year. I think he first, don't take my word for this, but I believe he first pushed that silly prediction in 2014, and then he was off by something like 35-40%, and then when it didn't happen, he pushed it again. I know he definitively stated gold would crash to $700 an ounce last year, and then when that didn't happen, I know for a fact he pushed it again this year and said it's going to crash to $700 again this year. And that's the kind of nonsense people focus on. If we pay attention to people saying that gold and silver will drop when we are long, confirmation bias makes us only pay attention to the most extreme predictions, and we tend not to pay any attention to moderate predictions that still may precede significant drops, and we brush aside the ridiculous predictions that can so easily be brushed aside because they are so ridiculous to confirm our biased opinions. And also on the flip side, the same goes for people when they're short PMs as well, as many tend to look at predictions of, oh, $5,000 gold is coming this year, $50 silver is coming this year, and then we brush aside these same ridiculous predictions to support our wrong assessments of being so tied and so married to the short position as well. So last year with our subscription Smart Knowledge Use services, we were long paper gold and long paper silver stocks for a total of approximately 35 to 40 trading days the entire year. That's it. So we got in, we made our profits, and we got out. And we also shorted paper gold and paper silver at various times as hedges against drops in the price of our physical stacks when we were long physical gold and physical silver at the same time. So assuming intelligent strategies to guard against real risks that will appear periodically does not make one a co-conspirator with a banking cartel, and does not make one desire lower gold and lower silver prices, but it simply makes one a reasonable, intelligent investor that's concerned about wealth preservation and wealth building, and in properly managing the banking industry's manipulation of gold and silver prices. So it is undeniable that from time to time, those in the gold and silver community allow emotions to get the best of them. And in fact, more than a decade ago, when I started in the gold and silver arena, I had learned very quickly not to allow emotions to rule my investment decisions. So, and any successful investor over time, that's successful over a long period of time. I'm not talking successful in 3 months or successful over 6 months time, but it's successful over many, many years will tell you that allowing emotions to run unchecked is a surefire way to become mired in lots of trouble. In order to have long-term success in an arena as price volatile as gold and silver, and we know it's a volatile arena, one has to be as close to emotionally neutral as possible. That is one of the best pieces of advice I can provide to you. So this is not about being right or wrong. People always, again, have to paint things in black and white, paint things in extremes, but that is a horrible way of assessing things. In fact, there should be no meaningful pause in this gold and silver price rate, and it continues to go higher. And the price drop that happened on March 23rd turns out to be the only significant price drop in PM mining stocks before they resume their roller coaster ride higher. Even though I don't believe this will be the case, this doesn't mean that one never succumbed to and partook in confirmation bias. Confirmation bias simply means throwing out opinions that don't agree with yours, only seeking positive reinforcement from opinions that agree with your own, and never considering other very realistic possibilities that disagree with your own. So when people ask me, what do I look for to know what price behavior is coming in gold and silver markets, I tell them I use a history of my observations over the last 10 years in gold and silver markets to assess when high reward periods have also become high risk periods, and when a pullback, and a significant pullback for mining stocks, is likely regardless of what technical indicators are saying. Again, let me repeat that for those of you that may have missed it. When I see a high risk of a bank rate in gold and silver coming, regardless of what technical charts state, I will pull back and exit mining stocks and paper gold and paper silver assets. This doesn't mean I'll be right 100% of the time in my assessments, because as I said, we pulled back early, so obviously I was not right in getting the market top correct in this rise in mining stocks. But again, no one will ever be able to perfectly predict tops and bottoms in any asset class. But it also does not mean that I don't have to guard against confirmation bias myself. Of course I do. So if my prediction of short-term market behavior does not materialize, I have to guard against confirmation bias to ensure that I don't misinterpret data and I don't remain married to a wrong viewpoint. I must always remain objective in my interpretation of data to understand what course of action will be best if the expected event does not occur. In other words, if you guard, and we all must guard against confirmation bias, we must basically remain objective in our analysis of data and not become married to a certain opinion and not let our egos drive our assessments by saying, oh, I can't be wrong, so I'm just going to continue to stay married to this opinion until it becomes right. No, we must be able to become flexible in our opinions, and if data is driving a shift in our opinion, then we must shift our opinion and then go with a new outlook. So that can be an extremely difficult task that often only can be honed by direct experience with not just an upcycle or not just a 3-month period or a 6-month period of experience in an asset class, but one must also experience down cycles as well. And at best, actually, one should experience multiple up and down cycles before you really understand how your opinion should be formulated. So often those that fall victims to confirmation bias and emotional decision making and are immune from emotional neutrality, which I believe is the best position, are those that lack experience with multiple stages of cycles and with multiple cycles, because only this experience can grant one the ability to intelligently and properly assess data and banker manipulation schemes. For example, if one's own confirmation bias is reinforced by subsequent events that confirm one's biased beliefs, this may actually be the worst possible outcome, even if it leads to massive yields, because what this will do is it will color one's future decisions that will enable one to take excessive risks, even more excessive risks than one previously took. And as I said, once one keeps taking excessive risks, although it can lead to excessive reward, it's going to lead to tragedy at some point. So this lack of experience, as I've already stated, can cause one to latch on only to articles that one desires to see. So during rising gold and rising silver price environments in recent times, it has been increasingly more common for analysts of even big banks to now make media appearances in which they tell the public to buy gold. And when this happens, it's very rare for those long gold and long silver assets to state that because bankers always lie, that one should not listen to their predictions of higher gold prices. In fact, they'll latch on to their predictions of higher gold prices. But when bankers then make public media predictions about significantly lower gold prices being in the cards for your future, it's very common for those long gold and long silver assets to dismiss these predictions with the exclamation, look at who's making these predictions. Bankers always lie, so their predictions are a joke. But I guarantee you, there's going to come a time when bankers are going to predict, and it's going to be all over the mass financial media, of lower gold and lower silver prices. And, because at the beginning of this year, bankers were all making predictions of higher gold and higher silver prices, and everyone was fine with that. And no one should listen to them because they're bankers. But when they say it will go down, people say, oh, dismiss that because they're bankers. But the reality of the situation is they were right in the beginning, right, to say go long gold and go long silver. But anyone with decades of experience of being immersed in the banker propaganda war against gold understands that their propaganda tactics have evolved over the years to become much more sophisticated, and that they often will intersperse truth with their lies to lead to maximum confusion. So you can't just dismiss what bankers say all the time about gold and silver anymore, whereas 10 years ago, you might be able to do that, because they will intersperse truth, as they did at the beginning of this year, and then tell lies, so it will lead to maximum confusion. And those that have followed my vlogs and my online blog, you also know that last year I discussed multiple fake technical breakouts that caused many PM and analysts in the blogosphere to state that huge breakouts in gold and huge breakouts in silver were imminent last year, but these breakouts never materialized. So that's why you have to assess much more data than just technical charts. This year, in recent weeks, the same trend has continued. So, for example, let me just, because so many readers send us headlines and article snippets, let me just read some of the headlines and snippets that have been sent to us in the past couple of weeks. So this happened a couple of weeks ago, and someone sent us a snippet from an article that said, with Good Friday and U.S. markets closed on March 25th, expect a spike of gold and silver prices at the end of this week, as those short gold and silver will cover their short positions into the long holiday weekend, because not only were markets closed on Friday, but they were closed on Monday as well for the European holiday, but that did not materialize. But here are some more. Buy gold, prepare for a massive rally, technician states. Another, gold stocks are screaming buy. Another headline. This one indicator says gold bullion is a screaming buy. Another headline. Buy gold will keep going up. And even on March 24th, we have an article that stated, as I previously explained in this podcast, quote, the dip to buy gold and silver stocks happened yesterday, end quote. Implying, of course, from that statement that there will be no further weakness in gold and silver mining stocks as of March 24th. And, of course, all of these headlines will be gobbled up by those that wish for gold and silver mining stocks to not have any significant pullback and to keep climbing higher, as confirmation bias dictates that's how they process information. So I don't even know from where these headlines and snippets came from, because my staff just reads emails as I receive them and compiles the headlines for me to read later. Sometimes if I see an article, a headline article I'm interested in, I'll have my staff actually go read the entire article. And if the reader provided a accompanying article URL, which sometimes they do, sometimes they don't, just to see if there's anything useful. But as I said, since the herd is always going one way, 99 times out of 100, there's nothing useful in any of these articles. So at the current time, nearly the entire herd is stating that there will be no pullback in gold and silver prices, that gold and silver paper assets will just continue to keep climbing higher and higher and higher. And the fact that sentiment in the gold and silver community is so optimistic and so lopsided as we start April, this should be reason low for concern, in my opinion. I recall some viewers of our last vlog that we released on March 4th, actually thanking us for our courage and releasing a video that went against the sentiment of nearly every single gold and silver expert in the blogosphere at the time. But I don't really see just a release of our observations and our unbiased observations as courageous at all, even though I knew it would be an unpopular video. So people say, why would you release a video or a vlog that you know is going to be unpopular? It's because that's what our focus has always been, in trying to release unbiased views, even if they are unpopular. And even if we are wrong from time to time, because like I said, we're not going to be right 100% of the time. And anyone that claims they're right 100% of the time is a demagogue, because no one is right 100% of the time. But there's a massive difference between being as objective as possible and still remaining an advocate of gold and silver assets, which we are, and being a blind cheerleader for precious metals just because one has a vested interest in seeing higher fiat currency prices that can usher in the collapse of the new world banking order. Quite simply, one position is an intelligent position and one is not. So I leave the unbridled, blind, and brainwashed cheerleading for mainstream financial media, as they seem quite fond of this tactic. And the fact that mainstream financial media has produced dozens of stories recently, I'm talking recently in March, these stories were still coming out that now is the time to buy gold at the end of March. This should also be a worrisome short-term indicator. Bankers control all mainstream financial media headlines, and we know that bankers are never going to tell you what the right thing to do is 100% of the time. And in fact, most of the time they're going to tell you the wrong thing to do. So that I find is a troubling aspect too, even though, again, I say confirmation bias will lead most people to dismiss that. So while unbridled cheerleading can leave people feeling good about their positions, it often will lead people astray from intelligent decisions. So on the contrary, this is not to say that low risk, high reward strategies, which we advocate at Smart Knowledge U, will always be correct as well. Though these strategies have worked very well for us for the past couple of years, when the banking cartel's price suppression schemes against gold and silver fail, gold and silver prices will rise against all odds, and there is a chance we will miss out on the first phase of the runaway gold and silver train. However, I do find it really difficult to understand why so many people this past quarter, first quarter of 2016, were back on board stating 100 to 500 silver prices and $8,000 to $10,000 an ounce gold prices were coming based upon just this recent small move higher in gold and silver US dollar prices. And I say small move because it seemed all people making these silly statements about precious markets, metal markets now being freed from banker manipulation seem to have forgotten that gold was near $1,800 an ounce and silver over $35 an ounce just 3.5 years ago. Remember, 3.5 years ago. That's not that long a period ago. And at that time, these proclamations were being made in the first quarter of 2016. Gold had not even regained $1,300 an ounce, and silver had not even regained half of its price from 3.5 years ago. And half of that $35 an ounce price would be $17.50 an ounce. So had gold and silver, really, this is why I say it's ridiculous for people to say gold and silver are free from banker manipulation now. There's no way it's free from banker manipulation. Banker manipulation schemes are not as strong and not as robust, and they are much weaker than they have been, like I said, in 2008, 2011, but they certainly are not like totally out of the pictures, as a lot of people are saying, because if that were the case, gold would easily be over $1,500 an ounce now. Silver would easily be over $20 an ounce right now. So this has not yet happened. To say so is just foolish. And again, the reason many state that gold and silver paper assets will continue their trajectory straight higher is because they are free from banker manipulation. On the contrary, I contend that part of the reason they moved so quickly higher, again, in quarter one 2016, which will be a very unpopular sentiment again, is due to banker manipulation. So therein lies a risk at the current time as of April 1st, 2016, with precious metal mining stocks that have boomed very quickly, very rapidly. Clearly, paper gold and paper silver assets are not yet free of banker manipulation, even though I agree, like I said, their powers of manipulation are fading compared to their powers in 2008, 2011. And I am not saying that this will never happen, that their powers will never be completely out of the picture, and I'm bearish in gold and silver. This year, again, I was bearish all of last year, except for those 35 to 40 trading days we were long. Of course not. Again, that's a silly interpretation of my words as well. And that would only be an interpretation that someone that is susceptible to confirmation bias would come up with. Especially given that stated in our Smart Knowledge U Block 13 that I'm bullish on gold and silver for this year. But I'm bullish in a way that's tailored to low risk, high reward strategies and not subject to the unsettling temperament of high risk, high reward strategies that often lead to tremendous gains, but also lead to tremendous wipeouts in capital, from which are very difficult to recover. So again, I say if a significant pullback occurs in gold and silver, I'm not saying extreme Harry Dent-like pullback in gold and silver asset prices, but just a moderately significant pullback in gold and silver prices occur, I guarantee you out of the woodwork, everything will come saying gold and silver are crashing, and even those that say gold and silver are going to go to $100 an ounce this year and over $3,000 an ounce this year, I guarantee you some of them will change their tune and say, here we go again, and get on the other side saying, oh, now we're at risk for a greater pullback than in reality would be true. So many people think that the slow and steady gains of low risk, high reward strategies are unsexy. They are probably unsexy, and therefore they're not for them, because there's a lot of adrenaline junkies out there that want the returns and the adrenaline thrills of very fast, quick, rapid returns. So while many times low risk, high reward strategies create slow, steady gains, because gold and silver assets, even when this rise, are so undervalued still, there will be a time when low risk, high reward strategies will also yield quick, rapid gains as well. And we have proven this because that's Smart Knowledge U, because we use low risk, high reward strategies in 2009 to yield a 63.32% return in 1 year to our Crisis Investment Opportunity newsletter subscribers, and an even larger gain to our Platinum subscribers that year. So those, we have had those years where we've had 1,000% 10 baggers, more than 1,000% returns in junior mining gold stocks. That has happened with us using low risk, high reward strategies. And I think in the future that will happen again with us. But we tend to stick with low risk, high reward strategies, because high risk, high reward strategies are usually those that are used by for those that are new to the game and have only experienced the thrills of quick, rapid upside, which are the thrills that happened in the first quarter of 2016, but yet have yet to be exposed to the lows of a plunging, rapid downside. So obviously, I should wrap up this podcast soon because I'm getting tongue-tied here. Being able to formulate coherent thoughts. So let me just say, for those that have followed me for years now, one knows I view physical gold and physical silver assets in a completely different light than I view paper gold and paper silver assets. And I see pullbacks in prices of precious metals as an opportunity to add to current stacks of physical precious metals. As I stated numerous times, and even in recent vlogs, if you haven't seen it, go seek them out. What I talk about is the real value of physical precious metals. It's its weight. It has nothing to do with the manipulated fiat currency prices that bankers use to state as the value. That's a false value for physical precious metals. So therefore, the value, since its weight, never changes. So when bankers manipulate prices of precious metals downward, remember I said prices, not value, this only provides an opportunity to accumulate the same value of precious metals at cheaper fiat currency prices. So have there been signs in recent months that the banking cartel's manipulation of gold and silver prices is failing? I've actually covered that point, so let's not beat that to death. And I would like to state that we also apply our low risk, high reward strategies in the PM market to US stock market. So if we tend to go short, we feel that those periods when we go short are low risk, high reward strategies, and that has resulted in some very rapid gains. And in fact, sometimes that has resulted in gains of 70-80% in just 1 week when we have been involved in trying to play the US stock market. So we'll provide specific details about our strategies in precious metal markets, our strategies in US stock markets, and our subscription-only services. If you're interested in learning more about this, please visit our website at smartknowledgeu.com and read our very detailed and extensive fact sheets about our Crisis Investment Opportunities newsletter and our Platinum member services. So in those subscription-only services, we let you know when we short paper gold and paper silver assets, when we go long paper gold and paper silver assets, when we're long physical gold, physical silver assets, specifically at what prices we buy these assets, specifically at what prices we sell these assets. Okay, like I said, let's wrap this up. Please let us know in the comments below, if you're listening to this podcast on YouTube, if you've ever been a victim of confirmation bias, because I really do want this forum to become an educational forum for people, because this is something that is real. Confirmation bias is real, and most of us fall victim to us, but because we are ego-driven creatures, all of us are ego-driven creatures, we don't want to admit that we can fall victim to confirmation bias. So it takes a very open mind to admit that we may possibly be a victim of confirmation bias, but being able to recognize that we have been a victim allows us to avoid becoming a victim to confirmation bias in the future. So let us know if you've been a victim in the past, if it's led to losses in your investing career in the past, and how you realize that you had become a victim and how you shifted your strategies to prevent a repeat of this mistake. Because remember, as I said, for those that say they've never made mistakes, that they've had like a 99% success rate, you know those people are snake oil salesmen, because everyone makes mistakes. But it's whether you correct past mistakes or whether you keep repeating them that determines whether you are a success or a failure long term. In conclusion, even though the subject of this podcast is confirmation bias, I still expect some to succumb to confirmation bias and thumbs down this podcast simply because one disagrees with the possibility that one could ever succumb to confirmation bias. So wrap your head around that statement. But I hope that this discussion in this podcast has helped you identify confirmation bias in your own life and helps you avoid the sinister psychological trap in the future. As always, thanks for listening. Please share this podcast with others in the gold and silver community and others in the investment community, just in general, if you believe they may be assisted by this discussion. And as I always say, remain intensely curious, because an open mind is one of the best ways to fight the ill effects of confirmation bias. Okay, thanks a lot again. As I said, we have future vlogs that we've already recorded that have not yet released. I have a great idea again for another vlog or podcast that I'm going to release shortly as well. So please hit the subscribe button below if you have not yet subscribed to our Smart Knowledge U YouTube channel. So long.